Good afternoon. Thank you all for joining us. This is our fourth talk here this semester, and this is the largest crowd we have had so far. So thank you so much for coming. Our speaker next week is going to be Robert Lukvar, who is CEO at NatG. That is a Houston-based company. It's a new company, and it works on natural gas-based transportation, and he's going to speak to us on transforming America's transportation system with natural gas. It's going to be a really fascinating talk, and I personally am really looking forward to it. I hope most of you can join us. I see several new faces here, so I should mention that we have this event every week on Thursday, the same time and same location, 5:15 to 6:15. So feel free to check out the website, the Energy Institute. We have the list of all the speakers. You can just close your eyes and show up at 5:15, and there is something going on. So it would be great to see you back again here. It's a great pleasure to introduce our speaker today, Helen Curry, who is a senior economist with ConocoPhillips, where she currently oversees the long-range plan development in addition to advising on investment analysis, political risks, scenario planning, and other strategic activities. From 2007 to 2010, Dr. Curry was with BG Group, where she was leading the America's Market Fundamentals research team. She really has been at many places and done many, many great things. Before joining Conoco in 2001, she was actually on the faculty of Elon University and the Lagrange College for MBA and undergraduate finance and economics programs. If you have not guessed it by now, she's a financial economist by training and got her PhD in finance from Mississippi State University. She holds a MA in economics from the University of Washington and a BA in economics from Millsaps College. Please join me in welcoming Helen.
Let's get logistics here. Thank you for having me. So it's a pleasure to be here. ConocoPhillips is happy to do anything we can to support the activities here at the University of Texas, Macomb School, other schools as well we're involved in. As was indicated, so my background's somewhat varied. I'll mention this for your sake, so if you want to ask questions, you're welcome to ask questions about anything. So part of my background at ConocoPhillips has also been in risk management. So I've run risk groups on the trade floors for all of the commodity groups we have, from natural gas and NGLs, crude and refined products. So that's a very interesting area to work in as well. So for those of you interested in that, feel free to ask about what does one do other than trade. There are plenty of other jobs on trade floors besides trading. You may already know that. So the remarks I have prepared for tonight are more, I tried to strike a balance between settling on slides that I thought you might have some familiarity with, but others that would pique your interest a bit. This is primarily what I call a fundamental analysis type slide deck. So we're really talking about supply and demand, more so on the supply side in these slides. We won't necessarily touch on pricing, but if you have questions about what are markets doing, why are they doing it, we can certainly delve into that. So just feel free to ask and just ask questions throughout as I go through this also. It's much more fun for both of us if it's interactive. So feel free to ask some questions. Our legal disclosures, the lawyers in the room will be familiar with this. Don't try to read that. Just it says. Whatever I say, you can't hold me liable for it if it's forward-looking. So that's fine. Who is ConocoPhillips? So just a brief moment of what kind of a company is ConocoPhillips. So you may be familiar with the fact that ConocoPhillips for many years was an integrated oil and gas and refining company. So the company I now work for, which still holds the name ConocoPhillips, is a pure upstream player, a pure play E&P company, exploration and production company. So the refining and a lot of the marketing activity was spun off into a separately traded company named Phillips 66, which is a wholly, entirely separate legal entity now. What ConocoPhillips does is explore for and produce oil and natural gas and the natural gas liquids that come along with that. We We still have a global footprint. We have over 17,500 employees, give or take a few, primarily in Houston. We have offices in a half dozen other locations around the world. I'm not going to read through all of this. And that's just a quick glimpse of, as I was mentioning, the fact that we are a global company. We do a lot of exploring in a number of countries, and then there are other countries that we do both exploration and production. So with that, so what is the big news these days is American renaissance in oil and gas production. What comes after that? Manufacturing renaissance, chemicals renaissance. The advent of shale gas and more recently what we call tight oil production is truly amazing. And this is an event that no matter what field you work in or think you might want to work in the future, this, I would assert, will have some impact on your life. You don't have to live in the United States either. What we have done in this industry, I think, is truly phenomenal in the last decade. It's really impressive. So, a quick glimpse of two boring graphs. So what are we saying here? On the one hand, the U.S. was the largest producer of natural gas in 2011. Okay, fine. Why does that matter? That matters because in the not too distant future, this industry was spending what amounted to roughly, $17 billion on regasification terminals here in the United States to bring natural gas here because we thought we were running out and would need to import it. So take that as a lesson in long-term planning and investment risk. So where we landed in terms of production, the U.S. started ramping up natural gas production courtesy of shale plays. We would probably have been the top producer in the world in 2012 as well. However, what happened? Natural gas prices tanked in the second half of 2008. So slowly, rigs started being diverted to oil or just, in some instances, set idle, but not so much so. It's more the case that they switched to oil, and we'll touch on that later. So then getting to oil, on the right-hand side, we can make a statement that, again, in the not-too-distant past, no one would have expected us to be making, which is that the U.S. had the largest growth in crude oil in the last 5 years here, from 2008 to 12. Okay. These are very impactful statements. So where are the shale plays? This is a graph, or map rather. You can get this from the government website, Energy Information Administration. If you're not familiar with this website, if you work in the energy industry or investments even, you will probably become very familiar with it. Because a nice thing about the United States is we have a ton of data that enables research to be done. So this is a map you can download for yourself. The point I want to make here is to notice that the shale plays, and this includes tight oil as well, the oil plays, they're spread across the continent here in the United States. That becomes very important in some of the market price dynamics, particularly for natural gas. More recently, it's become very important for oil, more from the transportation and logistics side of getting the oil from where it's getting pulled out of the ground, getting it to refineries. So, as I was mentioning, we ramped up natural gas production. If you focus on the orange and gray graph here, you can see shale gas production is projected to be over half of the U.S. production in the not-too-distant future. Okay. It's currently at least a third, roughly a third, depending on whose numbers you look at, of U.S. dry gas production comes from the shale plays alone. Okay. You still, needless to say, you still have a significant amount of production from legacy wells, from existing production. It takes time for those wells to decline, so you still have a lot of production coming out of those older wells. But all of the newer drilling, or the vast majority of the newer drilling, is occurring in the shale plays. Okay? And that's not just because we like shale. Why do we like shale? Business students. What's your objective function? Yes, thank you. That's okay to say that. To make money. Profit maximization. Shareholder wealth maximization. Okay, so running my business, what I want to do, to the extent I have the flexibility, I obviously want to invest in those assets that will generate the highest return. Okay, many of the shale wells will break even at very low, what we consider today very low prices, and I've got another slide on that. But the story to follow a slightly different storyline here is, so we ramp up all this shale production, and then look on the right-hand side, going back to the LNG import point that I made a few minutes ago. So what I have graphed there that you can compare are projections from the government Energy Information Administration. Their projections over a series of years of how much LNG we would be importing into the United States. Okay, and just you can observe how they just work their way down year after year. And then the most recent outlook from EIA confessed we're going to be a net exporter. Okay, if you want to get nitpicky, yes, there will be a few LNG cargoes come in because there are a few terminals such as Everett in Boston and Cove Point, both on the East Coast. They have some specific contracts, so there will be some small amounts of LNG that will come here. But all in all, we will be looking at being a net exporter of natural gas. And as you know, there are terminals that are already approved to be able to export. And ground has been broken. This is moving forward. As I'm saying here, what enables those LNG exports, one thing that enables them is the break-even cost. Many shale wells are extremely, extremely economic. Now, why do I keep saying extremely? Because in comparison to some of these break-even rates, if you look at what we would call a conventional well break-even price, or what was a fashionable at one time were the coal bed methane or coal seam gas wells in some parts of the country. Those were attractive at one time, but relative to what you can get with the shale wells, the break-evens here, your return on your investment is much more attractive. Furthermore, you tend to have a much shorter payback period. So that becomes important in explaining why you saw so many small companies, still do see a lot of small companies in the United States and in Canada that can specialize in one basin, or they jump in and they jump out of a play over time. That's because the break-evens, or rather the paybacks, the cash flow stream that you get from drilling your well and bringing it online, gives you a fairly fast payback period. Rough numbers would be 2 years. Some of them will pay back sooner than that, 2 to 3 years on some very good wells. That's in contrast to looking at more conventional type of wells that would have a payback more in the 7, 8, 9 year range. So these metrics become very important when you're talking to a financier and seeking capital to be able to get your rigs and drill your wells. So the point here, as I said at the bottom, is we have a tremendous amount of natural gas in the U.S. and Canada that we can bring to market at a $5, and that's a Henry Hub, $5 Henry Hub price. Okay. Does everybody know what Henry Hub is? Okay, so Henry Hub is the benchmark natural gas price for the United States and Canada. Some would say for the world, that's a whole other discussion. But for the United States, and the United States and Canada's gas markets are very highly integrated, so you can treat them as one. So Henry Hub physically happens to be a place in rural Louisiana on the coast near Erath, Louisiana. Find it on Google Maps. It's a tie-in for a lot of pipelines come ashore, and where pipelines interconnect and are going to the east and northeast. So it found itself being the central pricing point for U.S. natural gas many years ago. So we tend to talk about things in terms of Henry Hub. But that being said, it's important for you to know there are also many dozens of other pricing points for natural gas across the country. So going through time, I mentioned earlier that shale gas sort of set everybody on fire. That started to really ramp up in 2008. Well, I should go back up a little. It really started ramping up in 2007 probably because Haynesville was starting to come on big in 2000, by 2008, and Marcellus was coming on really big right behind that. And of course, prices peaked in July of 2008 and then started to plummet. So what then happened, as I said, look at the blue line for gas rigs. It peaked, the rigs peaked late August, early September of 2008, and then they started declining rapidly. People started then moving those rigs to what you see as the red line, the oil rigs, rising. So that's where our higher returns are. Oil prices have still tended to be, WTI has still tended to be 80, 90, more recently over $100, whereas the natural gas prices have walked their way down to the $5 and $4 and then $3 neighborhood. So I get a much higher return from drilling a liquids-oriented well, in this case oil, than I do from natural gas, all else being equal. So, what has all this drilling culminated in for oil? Texas is now back over recent data point, 2.5 million barrels a day of oil out of Texas alone. Okay. That's a fairly impressive volume. North Dakota, North Dakota was traditionally known for, it's one of the states that has what? More cattle than people. So, and that's fine. There's nothing wrong with that. They now have a lot more people. So we've had to build hotels, build trailer parks. They tend to be called man camps where the workers can live because there's nothing there. It's not places for them to live. So it's sort of the same thing we did up in Fort McMurray, Alberta, years earlier with the Canadian oil sands. North Dakota has had a huge economic boom resulting from all the drilling activity. But that being said, their oil production is now roughly 800,000 barrels a day. Okay. Natural gas liquids. Let's touch on this a second. Why do we care about natural gas liquids? What are they? Where's our chemists? I'm not a chemist, so this is easy. Butane, propane. The pentanes or pentane pluses, we tend to throw those all into one bucket. Those are fine. What's my problem child? The ethane, thank you. So rough average numbers for a barrel of NGLs in the United States. Rough cut would be 35, 40%, sometimes higher of that is ethane. So volume of barrel is, the biggest part of it is ethane. And then I've got pieces of propane and butane that can come in around 15% or so each, and then the rest pentane pluses. So that's all well and good. Physically, so this stuff comes up out of the ground along with my oil and gas. Okay, it has value, but each of these different parts of the barrel have different amounts of value. So I sometimes, depending on where the production is, I can be challenged to get the production to market because, one, there may not be enough NGL infrastructure out in the field, as we would say. Moreover, with the case of natural gas, when I get NGLs coming up with natural gas production, I have to meet pipeline specifications for that natural gas going into the pipeline. So we tend to take NGLs out. You can leave some ethane in, but again, there's a calorific or energy content specification that natural gas has to meet for the pipelines. So I need to be able to take enough ethane out. You've seen a considerable amount of what we call ethane rejection, which is leaving ethane in the gas stream over the last year because ethane prices were so low. It wasn't economic to take it out. The yet worse case that goes beyond that for a producer is when I have to shut in a well, or I think about shutting in a well, because I can't get enough ethane out of the gas to be able to send the gas down the pipeline. It really becomes a problem. But the good side of the NGL story is that this is what's leading us to what you hear about in the chemical manufacturing industry regarding production renaissance in the United States for petchems, for your Dows, your Monsantos, your LyondellBasels, and so forth. This is why you now see a lot of construction activity occurring primarily on the Gulf Coast, to a lesser extent in the Northeast, to accommodate more of these NGLs and to be able to produce more chemicals, plastics, and polypropylenes and so forth, all of those things. Did you have a question? Okay. But the graph I have for you on the bottom right there just is intended to show you the relative advantage that the U.S. has over, in this case, Singapore, where we won't go into all of the details of crackers, but you're comparing here Singapore, where they're primarily going to crack naphtha, versus Mont Belvieu, which is just on the other side of Houston, for ethane. The price ratio of those two, that line going down means the United States, means Mont Belvieu prices are much more attractive if I'm buying this as feedstock. Okay, so this, in a nutshell, underlies why you see a lot of new job opportunities in the U.S. in the chemical sector. Okay, let's go look at all of this from yet another angle. Okay, so on the left-hand side here, I've just plotted a few. I've selected some shale gas and tight oil plays, and what I'm trying to show you is just how steeply these have ramped up in certain cases. And as I was mentioning earlier, infrastructure can be a challenge because these are physical molecules or barrels. So it's not just a piece of paper that I can buy and sell and trade. I've got to physically get this stuff from the wellhead where it comes out to a market hub or a refinery. So this has been a challenge in many locations. What has it led to? On the right-hand side is simply a summary of all of the midstream companies in the U.S., their CapEx over the last 7 or 8 years there. Just illustrating how much money has been spent, and this will continue. We're still building pipelines, we're still building gas processing plants, and so forth. So this will continue. This is all good economic activity. Okay, got to build pipelines. The Marcellus would have ramped up even faster. If you can find the red line on the top graph there, Marcellus, that's Appalachia. So New England has traditionally been a gas-consuming area, wasn't traditionally a gas-producing area. So now that they have the Marcellus play literally in their backyard, we've had to build a lot of gas processing to get the liquids out of the gas, along with pipelines to be able to move the gas, in some cases, back south, as well as further to the coast. To touch on the liquid side, I was mentioning earlier about Bakken production and the fact that Bakken is largely been an undeveloped, or that part of North Dakota has largely been just very rural, just pastures, prairie land, and so forth. So in order to get the oil from middle of North Dakota to New Jersey or to New Orleans, or technically Baton Rouge or Houston, the ship channel, to get the oil from there to the refineries, we've had to work on pipelines, both small pipelines to get the liquids from the field to a major trunk line, as well as bigger, more expansions and in many cases redirections of liquids pipes to be able to move the liquids to the refineries. The other big story on Bakken production is, you may have heard about, is rail. You hear, we are moving a lot of crude by rail these days, and that's been a godsend to enabling the Bakken production to be able to get to market. Now, here's a side story we'll go into. So many producers out of Bakken have stacked their carts, particularly this time a year ago, towards putting their barrels on rail cars. And some of them have ordered a lot of rail cars, and some of them lease, and there's any number of legal arrangements you can go into with how you're going to move your barrels by rail. That was generating great returns for them as long as the WTI, the price spread between WTI and Brent was very wide, which you may, for those of you who follow this, you will recall earlier this year, last fall, WTI to Brent was tending to be very widespread, $10, $15 for a while. It stayed around in the upper teens, around 20. So it was very profitable to be able to move your barrel directly from North Dakota to, say, the Gulf Coast, where I could sell it at a Brent-type price, which was, again, Brent being $20 above WTI. In contrast to that, if I'm putting my barrel on a pipeline, it's from that part of the country, it's physically going to go somewhere near Cushing, Oklahoma, which is the price point for WTI. So people who were relying more so on pipelines, which my company did, it was a conscious decision to do that, and in hindsight, it's now starting to pay off. But for a time there, we were not getting as high a return on those barrels that were being priced off a WTI-related price. And that's simply because it was so much lower than the coastal price. Now that the WTI Brent spread has come back compressed in what we would consider a more normal range of $3, $5, $7, you're not seeing as much of a profit incentive for putting your barrels out of Bakken onto rail cars. Okay, that's probably more of a tangent than I intended to go down, but happy to go back and talk more about that if that's something that interests you. Because I threw a lot of jargon at you just now in the process of explaining that. Okay, so talking about prices, since we've wandered into this, this is just a little bit of background again. If this is something you don't follow, then a lot of what I just said just kind of went in one ear and out the other. But I'd like for this to take on some meaning for you. So to put it again, try to give you some perspective here. So a little history on the left-hand side of Brent prices, which, just like many commodity prices, you see the peak there in 2008. Do I have a pointer? No, never mind. Got a peak in 2008 and then a trough, and then we came back up quite dramatically. So if I showed you WTI, the plot would look almost identical because for many years WTI and Brent tended to price within a couple of dollars of each other. In fact, for many years, the relationship we looked for was WTI is $1.50 over Brent. That was kind of the standard, excuse me, kind of the standard planning differential. That relationship is no longer there. In fact, it's reversed. Okay, and as I was mentioning, when you go back to a year and a half ago, 2 years ago, you saw the spread between WTI and Brent widen dramatically. Okay, I haven't said anything about why did that happen, and you haven't asked me. You've let me by with this. Why did WTI depress? Why did WTI fall so much relative to Brent? Okay. Once again, we're talking about physical markets here. So I said a lot of the country's production kind of clusters down through the mid-continent in and around Cushing, Oklahoma, where there's lots and lots of tank farms. So what we ended up with was a situation where we literally had more roads into Cushing than we had roads out, roads in this case being pipelines. So we had a glut of oil at Cushing. Once you started seeing pipelines, either pipelines from Cushing to the Gulf Coast, in one case there was a pipeline called Seaway that had to get reversed, and that started filling and flowing from Oklahoma south to the Gulf Coast earlier this year. We've had other pipelines get added to bring oil directly to the Gulf Coast. That has helped WTI to rise back up to what we would call the global oil price. Okay. Another wrinkle I'll throw in here if you're interested is you didn't just see the spread between Brent and WTI blow out, with WTI down here, Brent up here. What was also going on that perhaps helps explain what I was just saying even more so is if you looked at the price for light oil, what we call Louisiana light sweet on the Gulf Coast. Louisiana is obviously a coastal oil. It was pricing right in line with Brent that whole time. Okay. In fact, it's tended to price, until more recently, it was tending to price a few dollars above Brent. Okay. It's a quality thing. So when we were able to move physical barrels from out of Cushing and get that to the Gulf Coast, you tended to see WTI rise back up where we've seen it more recently within a few dollars of LLS and of Brent. Okay. So looking forward, what we're tending to see on the right-hand side, you see a range of views on where Brent price is going to go. Okay. And just to to note this. The graph on the right-hand side is deflated, so everything's in 2013 dollars of today. You can see the futures curve is pretty severely backwardated. Do we know what backwardated means? Downward sloping, okay? Upward sloping futures curve is what? Contango. A contango futures curve is upward sloping, backwardated is downward. Okay, and that's a generic term. That's not just for Brent. Okay, so we have a fairly severely backwardated oil price curve. So the range, you can see, if you can see the gray area there, you can see that once you go out a few years, there's this vast disparity of views as to where our world oil price is going to go. Okay? The statement I just made is one of the key reasons I have a job, is advising a company on figuring out where our commodity price is going to go. That helps to dictate what do we invest in and where. Okay? So we have a perplexing problem right now. Where are they going? Okay? Two main schools of thought I can summarize here. Okay? Let's start with the easy one, the high side. Why would world oil prices stay, let's call it high, $130? That's higher than where they are now. What would make them stay that high or go that high? Okay, thank you. Supply and demand. All right, what does that mean? Yes, ma'am.
Perhaps some sort of restriction in supply, such as like OPEC, that will decrease the flow of oil, or like the distribution of oil, which will cause prices to go up as demand continues to increase.
Okay.
Especially like developing.
Very good, very good. We still see demand growing fairly robustly from the emerging markets, China being the poster child there. Yes, it is true. Everything you've heard is true regarding growth is slowing. But remember, the first word in that statement is growth. Growth is still occurring. The world economies, oil demand, natural gas demand, they are growing. What people seem to be getting less uncomfortable with is this rate of growth is what I would actually call more normal. What we expect to see now are rates of growth that are more normal. We got a little bit spoiled last decade, particularly the middle of last decade, with some growth rates for economies and year-over-year oil demand that were, in historical terms, exceptionally high. So it's an interesting observation on how few really positive data points someone has to observe before they suddenly want to think, I'm going to expect that next year. I'm going to expect that again next year and the year after, when the truth of the matter is that was the exception. So you need to step back and put things in perspective. Okay? So yes, thank you. We're still seeing growth in demand, and you hit on another key dynamic we've just totally glossed over here so far, is where does OPEC fall in all of this? So if I have North America ramping up its oil production, we're going to keep producing, what role does that leave for OPEC? Are we, and this bleeds into your politics, okay, and your foreign policy. So if the U.S., you've heard the term energy independent, it gets thrown around entirely too much. From a free trade perspective, it's, I would say, almost moot. So the U.S. and Canada as well, we can produce more and more and more oil, okay? It raises a question of, so how influential is OPEC in the future? Now, the past decade, I think the data supports that OPEC has performed fairly well in terms of responding to price changes. So if you buy into the thesis that OPEC can sort of manage ups and downs in world oil prices, if you're now entering a new world where OPEC is less influential, then where does that leave you? Do you state that question differently? Who is the swing producer? Is in the future, is the swing producer OPEC, or is the swing producer North American producers? Okay, and there are different aspects of those arguments as to how quickly would North American producers respond versus OPEC respond to a price signal, whether it's an upward shock or a downward shock. So But, okay, so we have growing growth. We have questions around is OPEC, what is OPEC's behavior going to be? One other thing you can throw in with OPEC is many of the member states of OPEC, Saudi Arabia in particular, need what we would call a fairly high oil price in order to support their social programs, their social spending programs in the country. Oil's what they primarily rely upon to fund their economy. So insofar as they've part of the Arab Spring aftermath was promising more payments to people in the country to keep them happy. So there are these political, socioeconomic reasons to expect upward pressure on oil prices. The other element you can throw in there that we've seen a lot recently, of course, are threats of war, disruptions in the Persian Gulf. More recently, it's been more disruptions in the Mediterranean, in the Eastern Mediterranean or in North Africa. Okay, so those events tend to put upward pressure on oil prices. And the interesting thing is, go back and look at your data for those of you who are doing research. In many cases, it's not necessarily the fact that a supply disruption occurred. Prices go up because people fear a supply disruption. And you don't necessarily see prices just come back down quickly when the expected supply disruption did not occur. It takes time for that to work itself back out. So that summarizes, to some extent, the argument for higher oil prices. Go down to the bottom of the curve. Why would we see Brent fall all the way down in today's dollars to about $73, $74? This morning it was at what? It was about 109 this morning. Yes, sir.
Potential technological breakthroughs.
That would, okay, so we have technological breakthroughs.
That would lower the price of each barrel.
Okay, good. It's going to lower my cost of production. Okay, yes, which then allows me to produce at lower prices. Okay, that is related to one of the key theses that is put forth by the institution that I will not name that's at the bottom of that gray area. Their thesis is something along those lines. So we the industry, have already demonstrated a learning curve, a cost savings in producing tight oil. The expectation then is that we will continue to get better at it, and we will be able to produce it at lower and lower costs. So why does that bring prices down? What this institution's argument rests upon is then gets into step away from production and go to the refining side. Okay, so all the oil that gets produced has to be refined. Okay, so in the United States, can I export crude oil? Generally, no. I've got to have exceptions. Alaska gets to be a special case, but it still requires case-by-case approval. But in general, I cannot just load up a tanker on the Gulf Coast and send it to China or to a refinery in Europe. It's a law against that. So it's been there since the 1970s. Most people don't know it exists. It can become problematic as we produce more and more oil in the United States. Because in the presence of that law, I can't export, I get to a point where I'm a captive producer. I can only sell my crude to a U.S. refiner. So if those refiners, they know I'm they know I'm coming, so who's in the stronger bargaining position? Okay, this is a school of thought. You don't have to agree with it. Okay, add on to that what the young lady over there was pointing out, but turn that upside down. If we don't have strong demand for refined products worldwide, then I end up with a glut of refined products in the world. That then puts downward pressure on the oil prices. Okay. But I just went through a ton of information very quickly. Okay, so that's actually a lot in what we just covered. Okay. But that's a school of thought. Like I said, everybody's in this business that they can sell their opinion. And that's the bottom edge of that gray area is the institution that believes we'll keep getting better at production. We'll be able to produce at lower prices. What that turns into is a world with a lot of crude and refined products and downward pressure on prices. You had a question?
I was wondering if this downward slope, whether the data from other countries has been considered, is although the U.S. is producing a lot more oil and gas than they used to, other countries who have nationalized industries, such as maybe Venezuela and Iran, are producing a lot less. They're getting a lot more demand from China now, but they're producing a lot less. So maybe wouldn't that make the curve steady? Because the prices have been pretty high for the last decade, and if these countries decide or simply can't up their production, for example, Venezuela keeps producing less and less oil every year, wouldn't this higher demand and a lower supply influence the curve to just maintain itself for maybe another decade?
Excellent points. Thank you. Yes, they could. So the idea is that we've already seen Venezuela kick out the international oil companies that were producing that, helping them produce that oil. The resource is still there. So generally, people's expectations already have baked into them a low or declining level of Venezuelan output. Much the same for Iran. You would have to have dramatic political shift or change in international policies to have growth out of Iran. So those are generally already baked into that. But you still make a fair point. If they decline further, then that puts upward pressure on prices. That means the U.S. producers probably are the ones that crank up higher. So you can walk yourself back into growth in U.S. production could exceed that which that additional amount we might lose from those two countries. But those are good things to think about. Yes, sir.
How does it change in the currency valuation of the dollar that oil prices long term?
I would assert there is not necessarily a definitive relationship there. You can find evidence both for and against that a weak dollar is going to correspond to a higher oil price. I think if there's any consensus, it's that the causality would flow from the FX rate to the oil price, not the reverse. Some people disagree with that. Some people do believe that it's the oil price influences the FX rate. I don't think the data supports that, but nonetheless, there are two sides to that argument. But like I said, you can find windows of time where it certainly appears that the FX rate, the U.S. dollar, because all of this is priced globally in U.S. dollars, is having a spillover effect on the oil price itself. In fact, that was one of the reasons one of the arguments for why OPEC let prices get so high in 2008 was because the dollar was weak. And there was all these arguments of they need the high oil price because the U.S. dollar is weak and they're going to convert it to euros or reals anyway. So they need more of those. So but that's a very good question. Thank you for bringing that up. Unfortunately, I don't think there's a definitive answer to it. Yes, ma'am.
Yes. What is the inflation rate for 2020 on this graph? Are these real oil prices, right?
They're real, so we just assumed something around 2.25%.
Oh.
Yeah, nothing.
20
Yeah. It's not a very fancy inflation or price index behind it. But even the nominal curve is downward sloping too. And so your nominal prices are backwardated as well. But there's not a huge amount of inflation that's coming out of that over time. Okay, so we just kind of covered the main schools of thought that create this range of outcomes rather, for oil prices falling versus oil prices rising. Okay. Yes.
Are those
for that graph, are the two schools of thought like one down and one up? Is there anything, are they like very split, or is there like a full range in between?
Oh, there's plenty in between, yes. Yes, and very good question. So if you looked at the individual lines or the individual forecasts comprising this gray area, yeah, there are plenty that are in the, probably the majority of them are in the $90 to $100 or 90 to 105 range, since this is Brent. The majority of them are in there, and it's which is closer to what I think makes a lot more sense. Is for all the arguments we've said, those notwithstanding, on average, all these things can happen. So prices move up and down. So on average, I think you're more likely to find yourself in that $95 to $105 range for Brent. Yes.
What do you think the likelihood of OPEC ramping up production to with the break-even price of most of these shale plays, so it goes below that and becomes uneconomical to drill? What do you think the likelihood that they do that, so they still have the geopolitical?
Very good question. That question's been asked at lots of companies, I think, is what if they do that? What if they do try to drive us out of business? Because that's what that amounts to. In essence, we don't think that would be likely to happen. One reason being what I mentioned a moment ago regarding many of, particularly the Saudis, needing a price of Brent of estimates are around $100 a barrel to be able to pay their government bills. Furthermore, you can start thinking through a lot of more strategic questions around what is there really for them to gain by driving many U.S. companies out of business. They can just as well come and lease some acreage here in the United States and enjoy part of the production here too, and they have refineries here too. So there's when you think it all through, there's not necessarily a dominant argument for them keeping prices really low for an extended period of time, such that it would disincentivize a lot of the U.S. production growth. But that is a good point to think about. And yes, that concern has been raised and has been talked about over time. Yeah, would they do that? What's the likelihood of them doing that? And I think most commentators would tend to give it a very low likelihood for the reasons I mentioned. Okay. What else do we have? We have natural gas prices now. So, again, Henry Hub just happens to be the central pricing point in the United States for natural gas. You can see, again, same type format on the charts. Left-hand side, prices for natural gas up and down all over the place. Same spike in 2008. I'll comment. There are more spikes in here because when we had bad hurricanes in the Gulf of Mexico, you have some of those in years like Katrina and Rita, and Henry Hub prices went very high when I think it was when Rita came ashore because a lot of production was shut in. So the main economic event was the 2008 spike and then the ensuing recession. But prices for natural gas, unlike oil, look at the contrast here. We go from the gray trough, and it came back up pretty quickly because oil demand is still growing. Economic growth worldwide is still positive. It's just not positive in every single country, and where it is positive, it's often a small number. For natural gas, it's, we learned, going back to the comment on technological progress and learning and getting better at what you're doing, this would tend to suggest we've done a good job of that with natural gas. A painfully good job for many producers. Because keep in mind, so more factoids for you. So I mentioned earlier, going back to pricing points, there are several dozen pricing points for natural gas across the country. So in some cases, whereas Henry Hub may be $3.50, if I'm producing in the Rockies, I'm producing in northwestern Colorado, I'm not getting $3.50 for that. No, I've got a differential back to that. So I may be getting $3. I may be getting 2.5. Okay, so sometimes Henry Hub looks like a good price because your production is somewhere in a remote location and it's got to travel across pipelines to get to the market center. Okay, but these prices notwithstanding, we still have, you saw in earlier slides, we still have a tremendous amount of gas production. It is still rising. Gas production is still rising. So that's attributable to the layup answer is, why does it keep rising if prices are so low? So the layup there is, well, there's associated gas that comes up with oil production. Okay? I don't necessarily seek to have that gas. It just comes up with the oil, so I get it. Okay? Why else does this gas production keep rising? Go back to the break-even cost slide. I have a lot of areas where even a 350 Henry Hub gets me, let's say, a 20 to 25 rate of return on a good well. Okay, so I still have positive economic incentives to keep producing natural gas. And then going to the right-hand side, again, forward-looking views on Henry Hub prices. Note the contrast here again with whereas with oil we had that gray area going very wide over time. So amazing here, there's an amazing amount of agreement or consensus around where are Henry Hub prices likely to go over the rest of this decade. 3.5 to 5.5 is what we have highlighted here. That's down from in 2009 and 10. Things were walking their way down to people were starting to say 5 to 7, then you heard 4 to 6. This just happens to be where we are today at about 3.5 to 5.5. Okay, but once again, there's a tremendous amount of evidence that continues to filter its way through the industry to understand the fact that if you think of a cost of supply curve for natural gas, there's a very long flat area, meaning I can produce a lot of gas from a lot of different locations profitably with prices in the $4 to $6 range. And I can do that for a very long period of time. If you then map that from how much those gas, that production back to the resource, there's a tremendous amount of resource to enable that production to keep occurring. I think it was American Natural Gas Alliance, ANGA, go to their website. So it was, they first came out with the 100-year supply statement, I believe in 2010. It may have been late 2009. The statement that if you look at America's natural gas resources, at today's consumption levels, we have easily a 100-year supply. And that statement's now 3 years old. Okay, so again, in the case of natural gas, here you have less geopolitics that start to get involved. It's more of a true supply and demand reflection. And in this case, there's a lot more consensus around we have a lot of supply that we can bring to bear. Okay? So you should be asking. Go ahead. Yeah.
I just have a question about LNG exports and regarding that.
That's what I was about to say. Someone should ask. So ask.
Well, just to what extent that's factored into that census rates that you had there, and there's obviously many locations, terminals, so at what point they all come on, that you start in different places.
Well, so thank you for that. So first of all, by 2020, in this time frame, there will only be a handful of those liquefaction terminals actually producing by this time. So a range that I would characterize as being widely accepted for LNG exports is 6 to 8 BCF a day in 2020 or by 2020. Now we don't start exporting until Cheniere's first cargoes are supposed to go out, I believe, in 2016. And those are contracted already. So that's volumes that technically are already sold. Okay, and that Cheniere is building that terminal. They're that they've expanded to a second train already. So roughly an expectation of 6 to 8 BCF a day in the latter part of the decade is what's baked into those expectations on prices. The real wild card gets to be in the next decade. Once we get beyond 2020, and as you were alluding to, there are, several dozen projects that would amount to, I have to translate the numbers, a lot more BCF a day of potential exports. If you look at liquefaction capacity and add up all of the 20 some odd liquefaction proposals, and again, they're proposals, their capacity adds up to significant volumes. But I would say arguably no one expects all of those terminals to get built. They are things that in some cases they're terminals that people have been talking about for 5 to 7 years now, and they don't get a toehold. In other cases, they're terminals that have companies that could fund them if the market conditions are right. But the final investment decisions for many of those terminals is not until 2015 to 2017 anyway. So if they make that decision to proceed with the investment and build the liquefaction, it wouldn't be coming online until the early part of next decade. So that's when the real wild cards start happening regarding how much world demand would there be to pull U.S. LNG or North American LNG, because it can go off the west coast of Canada if you get the pipelines built to move it to the coast. Another logistics challenge. Yes, sir. And we're,
Just that we have a few more minutes
Yes.
for questions, but when you get the question, could you just repeat it so we can capture it on the video?
oh, yes, thank you.
Okay, so this question is likely to reveal my poor training in economics or my inability to read a two-dimensional graph or both. But I'm having trouble reconciling this slide with a much earlier slide about the various natural gas plays and their break-even points in future dollars.
Mm-hmm.
In that slide, maybe the first 4 or 5 slides, it suggested that various phases of all these different shale plays, that they're, like phase 2 of the Haynesville is more expensive break-even point. And I think I saw it even at the very end of the slide, phase 3 of Haynesville, that was much higher break-even point. Presumably, they're re-entering wells that have already been drilled vertically and going off in different directions horizontally. Why would that be a higher break-even?
The simple answer, okay, so the question is, we're trying to reconcile the price outlook here with why, for example, the Haynesville, which we showed 3 tiers of Haynesville break-even costs earlier, how does that jive? How does that reconcile if the Haynesville Tier 3 had such a high break-even? Let me go back to that. There we go. And the key there is this is a full cycle cost. So you were actually talking your way into the answer. Once I get to, let's say, 2018 or 2019, I already have the land. I already have some of the capital is already sunk. So my marginal cost to produce in 2020 is not $5.50, that far left-hand bar. That is, like I said, a lot of that cost is already actually sunk by 2020. Okay. So, but no, you're actually were spot on in looking at that. And I should have pointed that out when I hit on the slides. Yeah, this is what you could view as the highest cost to get that gas out of the ground in these plays, because it's including my land and all my capital. So it's not my incremental production decision. Yes.
Do you foresee future limitations on carbon emissions, or either as legal limits on emissions or carbon taxes? And if so, how do you foresee the industry responding in terms of how it allocates its investment?
So, in a word, the question is regarding limits on carbon emissions and how do we respond to that. my company, which I can certainly speak for, yes, we do anticipate limits on carbon emissions. And to some extent, it's easy for me to answer that today because Obama's climate action plan, part of it is already starting to actually get written. The emissions on existing, the emissions for CO2 on existing power plants are starting to get written. EPA has its marching orders. Go do this. So, I'm sorry, for new power plants. The one that will come after that, that's less certain, is how they will treat existing CO2 emissions from existing power plants. But that is expected to be a follow-up rule from EPA. And these things primarily affect power plants. So that being said, what they do for us, those examples for U.S. carbon policies. So in general, their effect on power plants tends to advantage natural gas relative to coal, because coal tends to have much higher CO2 emissions, along with other things that we consider advantages to natural gas. I'm not in the coal business. Okay, so that's on the demand side. Other regulations around CO2 that we are facing are at the wellhead and along the transmission system. There are limits on all of our emissions, including CO2, that are continuing to work their way out that do affect our production. So we have to we spend to ensure that our production emits certainly no more than what the legal limit is, and secondly we try to go a little bit beyond that to ensure that we are a very clean producer from an emission standpoint. In general, carbon policies for the United States are something I would attest that all of the oil and gas producers think about, how is that going to affect me? I can only speak for my company's reaction to that is, at a minimum, we comply with everything the law, state, federal, local says, but we want to actually go beyond that and do better than that.
We can take one more question.
Yes?
Sort of following on that question about the things that the projections for oil prices, and you have to have it refined in the U.S. for the most part. So how would pending or future regulation on the refining side of things affect the projection for oil prices?
So the question is around if there are changes in regulations on refining, how does that affect our outlook on oil prices? So as long as if the regulation is a change in or a repeal in the law that currently prohibits quote free exports of crude oil, that to some extent makes life easier, because WTI and Brent should keep a normal trading relationship, and the price looks a lot like it did in that Brent slide, or somewhere in that range. Okay, the concern, like I was saying, was that if exports continue to be prohibited and production keeps rising, that we run into a backlog with the refineries. Now, if that happens, the refineries will start to invest more to be able to process more of the light sweet oil. Okay, and this gets into a topic that I didn't think we really don't have time to talk about, which is the different qualities of crude oil and how that has to match with the refining system. But that's, in a nutshell, that's what you're getting at, is the U.S. refineries would have to make some more investments to be able to run more of a lighter slate, which is turning them backwards from what many of them have invested in the last 10 years, which was to run a heavier slate. But the differentials the refining margins get wide enough, and the refiners will start to invest, and they'll be able to process more light.
Thank you so much for sharing your insights. Let's thank
you. Thank you.